All right, let's dive into the world of crypto trading. I know, from the outside it can seem super complex, almost like a whole other language. But our goal here today is to give you the basic building blocks to really make it all click, one step at a time. So, let's get right into it.
You hear it everywhere, right? People are trading crypto. But what does that actually mean? It's definitely more than just guessing when to buy low and sell high. See, there's this whole world of strategy and thinking that happens behind the scenes, and that is exactly what we are going to unpack today.
So here's our game plan. First, we're going to define what trading even is. Then, we'll look through the two lenses that traders use to see the market. After that, we'll explore different trading styles so you can see what might fit you. Get into the nitty-gritty of placing an order, and then wrap up with the single most important next step you can take.
Okay, first things first. Let's clear up one of the biggest points of confusion right from the get-go. You hear people use the words trading and investing like they're the same thing. They are not. In fact, they are two completely different mindsets for how to approach the market.
You know, the biggest difference really just boils down to time. Think of an investor like someone planting a tiny seed. They believe that over years, it's going to grow into a huge tree. They are in it for the long haul. A trader, though? A trader is more like a farmer trying to get several harvests in just one season. They're always on the move, trying to capture smaller, more frequent profits from the day-to-day changes in the market.
Right, so if traders aren't just buying and holding on for dear life, how on earth do they decide when to get in or get out? Well, it's not a coin flip, that's for sure. They use specific tools to build a case for their move. And most of the time, they're looking at the market through one of two main lenses to get a clear picture. The first lens is what we call fundamental analysis, or FA for short. And you can think of this as being a detective. Someone doing FA completely ignores the daily price swings and asks the big question: what is this thing actually worth? They dig into the technology, the team, the market, everything. Their whole goal is to figure out its true core value, and then see if the market is selling it for a bargain or if it's way overpriced.
Now the second lens is technical analysis, or TA. And if FA is the detective, TA is kind of like the chart psychologist. See, TA folks aren't so worried about the why. They have this core belief that everything, all the news, all the hope, all the fear, is already baked into the price you see on the chart. So they study these charts, looking for patterns that have happened before, believing those patterns can give them clues about what might happen next.
But here's the secret sauce. The really savvy traders, they usually don't just pick one lens. They use both. And there's a word for this: confluence. Just imagine your detective work. The FA tells you a project is solid and way undervalued. Then you look at the chart, the TA, and you see a classic pattern that suggests the price is about to go up. When both of your lenses are showing you the same thing, that's when your confidence in a trade can really skyrocket.
So, we know how traders think, but now let's talk about how they act. This brings us to trading styles. And while there are a bunch of them, the biggest difference between them all really comes down to one simple thing: time.
So starting with the longest time frame, we have the trend trader. You can picture this person as a surfer who's just waiting patiently for that one perfect massive wave. They spot a major direction in the market, a big bull run or a bear market, and they just ride it for months, sometimes even longer. They're trying to catch that one huge move, and they couldn't care less about the small, choppy waves in between.
Now, let's shorten the time frame just a bit. Here we find the swing trader. This is a super popular style, and for good reason. It's often a great place for beginners to start. Swing traders hold their positions for a few days to maybe a few weeks, and they're trying to catch the medium-term swings in the market. It's active enough to keep you engaged, but it's not so crazy fast that you feel overwhelmed.
Okay, now we're really cranking up the speed. The day trader, and the name kind of gives it away, lives their entire trading life inside one 24-hour day. They get in and get out of all their trades before their head even hits the pillow at night. This means no overnight risk. It's a pretty high-octane style that relies almost completely on technical analysis to cash in on tiny price moves during the day.
And finally, at the absolute peak of intensity, you've got the scalper. Now we are talking about trades that last minutes or sometimes even seconds. A scalper is not looking for a home run. They're trying to hit hundreds of little singles, just skimming tiny profits off of countless trades. It's an absolutely exhausting numbers game that requires just laser-like focus.
So we've got the theory, the analysis, the styles, we've got all that down. But what actually happens when you go to press the button? Let's get into the mechanics of the single most basic action in trading, placing an order. So the whole marketplace really lives inside something called the order book.
You can think of it as the engine room of the exchange. It is a live, constantly moving list of every single buy order and every single sell order for an asset, all neatly organized by price. This is literally where supply and demand meet in real time.
Now, when you actually go to place a trade, you have to make a choice. It's a trade-off. Do you want speed or do you want a specific price? A market order is all about speed. It's the get me in now button. It guarantees you'll get filled instantly at whatever the best price is at that exact second. A limit order, on the other hand, is all about price control. You say, I am only willing to buy or sell at this price and not a penny more or less. You get control, but you lose the guarantee that your order will ever actually go through.
And this gives us a great way to picture a really important idea called the bid-ask spread. Imagine a little gap. On one side, you have the highest price any buyer is willing to pay. That's the bid. On the other side, you have the lowest price any seller is willing to accept. That's the ask. That tiny space between them is the spread. When you place a market order, you're essentially paying a very small fee to just instantly jump across that gap and make the trade happen now.
Wow. Okay, we've covered a ton of ground. We've gone from these high-level strategies all the way down to the nuts and bolts of how an order book works. So, what now? What is the smartest, safest, most logical first step you can take to actually put all of this into practice?
The answer is something called paper trading. And this analogy is perfect. It really is like a flight simulator, but for traders. You get to use a system that looks and feels exactly like the real market. You can place orders, you can test every single thing we talked about today. But the only difference is you're using fake money. It is, without a doubt, the absolute best way to learn the ropes without risking a single dollar.
So, let's wrap this all up. What did we learn? First, trading is an active, short-term game. Second, you've got two lenses to analyze the market: fundamental analysis, the detective, and technical analysis, the chart psychologist. Third, your trading style is basically defined by your time frame. And fourth, you place your trades by choosing between speed with a market order or price with a limit order. But maybe the biggest takeaway of all? You can practice every bit of this in a totally safe environment, risk-free.
Here's the thing to remember. Every single trader out there, no matter how successful, started in the exact same spot you're in right now, with a question. Maybe it was, hey, can I actually learn to spot a pattern on a chart? Or maybe, I wonder if swing trading would fit my personality. The journey doesn't start with putting money on the line. It starts with curiosity. So as we finish up here, just ask yourself, what's the first question you want to find the answer to?